I'm excited to interview Kewsong from growing up in Albany. He went then to Cambridge for school, McKinsey, back to Harvard, Warburg Pincus, and now he is the co-CEO, of course, of Carlyle. And the most interesting thing, or one of the most interesting things I think to us at Bloomberg, is that Carlyle is the first firm, and I think still the only major private equity firm that has transitioned from the founders to a new generation of leadership, which is why it's so exciting to see what you're doing there. Let's talk first, though, about sort of the elephant in the room. I guess there are two elephants in the room at this conference. One of them is the Bain & Company report that everyone has been talking about. The other one is the coronavirus impact that we're seeing play out in public markets over the last 4 sessions in a serious way. And of course, the human tragedy that you must be concerned about as well. You've got employees in China. What's your take on the impact? You have exposure through fundraising there, but also through assets.
Sure. First of all, thank you for that lovely introduction, and good morning, everybody, and thank you to Super Returns and the conference organizers. Look, this is an evolving situation. We have to be concerned. First and foremost, I care most about our employees. We just have to make sure the health and welfare of our people are well taken care of, and we're doing everything we can. There's a lot of dislocation involved to make sure that protocols are in place. We're monitoring the situation very carefully. We're doing everything we can to help these affected people. Broadly speaking, families, also their portfolio companies. With respect to your question on impact, no doubt in the short term, there's a real impact. My guess is the impact will be greater than people think because this is such an unknown and uncertain situation that's still evolving. People are starting to just appreciate the magnitude of what could be happening. We are monitoring our portfolio companies very carefully. Travel is clearly down. Traffic in retail locations is down. The logistics and the supply chains have been disrupted. You can't have 40-50% of the world's second largest economy be sequestered in the way it has been and not have an impact globally. You can't have an economy that's in some shape or form touches 55% of manufacturing output globally that not have an impact on the world. We're watching, and there are probably 50, 60,000 containers that are in the wrong ports in the wrong locations. That all needs to be put back into the right place, and the supply chains need to get going again for the world economy to start powering forward. So I think the short-term impact is going to be real. The markets are clearly reading a lot into this. But I think it's also fair to say none of us are experts. This is a bit new, and to speculate, I think, is dangerous. So we're doing what we can with our people. We're monitoring our portfolio companies very carefully. If you take a step back over the longer term, and that's the business we're in, we're trying to figure out what we can control, what we can affect. My sense of it is we'll figure out a way to power through this. I'm hopeful for that. But clearly in the short term, my priorities have got to be driven by our people.
I want to talk about over the longer term with respect to private equity, private investing, but in terms of the public markets, it strikes me that they've actually been very optimistic about this. I mean, everybody we hear from, with the exception of Mohamed El-Erian, is expecting a V-shaped recovery. Right. And it's only been the last few days that the markets have really been rattled by this, even though you've got 50, 60 million people quarantined.
Disaffected current.
Rugby sevens and Formula One canceled. Carnival in Venice was just canceled. So this leads to my Bain & Company question, because their takeaway, or the FT's takeaway from the Bain & Company report, is that you have done better over the last 10 years investing in the S&P 500 than in private equity. First off, what do you think about that? It's not really what the report said. When I read it, I didn't take that away from it, but that's the headline. Who's done better?
Exactly. So I'm going to address that important question, but I just need to comment on the setup to your important question, which is, people can be alarmist about the virus, but we also have to take a step back longer term and appreciate global economy is powering through, and there are lots of good things to be talking about. Consumer sector is strong, industrial sector feels like it's bottomed out, and so yes, the short-term impact is quite real, but central banks are being accommodative. I think there are a lot of forces at work which on the underlying economy suggests that we can continue to see, low, albeit low, but steady growth, over a longer term. So that kind of is the backdrop for how we're thinking about the world. With respect to the Bain & Company report, I think it does a tremendous job of pointing out that over the past 10 years, public equities have outperformed their historical averages. And so the real question, the spotlight should be, I think, when does the reversion of the mean, or does the reversion to the mean occur? And the question is, for everybody in the audience, are you prepared to make a bet in your portfolio to allocate such that you're assuming there's going to be a 15% rate of return from public equities moving forward? Or do you expect a reversion back to the mean? Now, with respect to...
This is exactly my question. Right. So I was talking with Nikos Stathopoulos earlier from BC, sure. And my question is, can private equity do better in a downturn than public markets? Because you don't have the quarterly reports, because you don't have, the daily liquidity. Yeah,
it's not necessarily about the quarterly reports or the daily liquidity, but it's about how do we create value. So if you look at the report, multiples expanded in that 10-year time frame in the public markets by 60%. So multiples expanded by 60%, and that was the major driver of the public equity rate of return over that 10-year period of time. Now let's take a look at how private equity and how we at Carlyle drive returns. When we look at our returns, 2/3 of our returns are driven by operating improvements and growth. Less than 20% is driven by multiple expansion. So it's a very different model that we operate, which is for the over a long term, we partner with great management teams, we find great companies, we use the platform, our resources, our industry expertise, all the functional experts we have in human capital, in capital markets, in procurement, in digital technology. We apply that and we say, how can we grow? How can we add value? How can we make real operational change? And that's the basis for how we drive returns. So I think when people actually start to look at this report and examine it more closely, the bigger question isn't us versus them. It's going to be, first of all, the fact that we're no longer alternative. We're quite mainstream. We are a critical part of any portfolio's overall returns. The second question is going to be, do you assume that public markets can keep generating 15% moving forward, or is there going to be some reversion back to the mean? And then finally, the big question to ask is, can private capital continue to drive value in the way that it does? And in a downturn, we have levers, we have management teams we can bring to the equation. We don't have to worry about mark to market as much, right? So we have a lot more levers, and how do we control and drive value? I think the report's going to be great in bringing all that out for the industry.
How do you, there are so many situations now in China where we see small and mid-sized businesses that can't pay their debt. They've been closed for 3 or 4 weeks.
Right.
You're starting to see that in northern Italy as well, where nobody's going out to eat.
Right.
And those restaurant owners only have enough cash to get through another month.
Sure.
How does that affect businesses then that private equity owns that you own at Carlyle?
So we have to be concerned. But I think we've got great partners in our banks, and I think folks understand that this is likely to be a temporary and hopefully non-recurring type of a situation. So clearly Q1, maybe even Q2 are going to be hurt. And so we're already working closely with all of our partners to ensure that the companies are set up well, capitalized in the right way, and set up to have runway and patience. Because remember, we're in the long-term business, and our partners understand that. We're looking to generate value 3, 5, 8 years out. And yeah, there's a speed bump, and it's a real one. I want to make sure it's a real one. But I see that we push our way through this.
How do you work then? The coronavirus aside, we're still in a slow, stagnating growth scenario. German growth over the last quarter was...
Don't say stagnating. Say it's slowing down. I'm not so sure it's stagnating.
Well, other places, I guess it's better here. We get affected by the manufacturing picture on a more serious level. But you've already got almost no more room for monetary policy, right? We're negative here. You're only at 1% over there.
Right.
and fiscal help doesn't seem forthcoming, even though everyone's talking about it.
Right.
Berlin certainly isn't about to open the purse strings.
Right.
How do you make money in that scenario?
If I really knew that, I would be figuring out how to do that day to day.
You
right?
do, and you are.
So yeah, you bring up really interesting questions. First of all, in the U.S., the Fed has hiked 9 times, and so it's given 3 of those back. So it still has a little bit of room. I mean, people think it's totally out of ammunition. That's not quite true. It is constrained, but not totally out of ammunition. Clearly, in Europe, there are less bullets that can be fired. And that brings up
they don't hurt as much.
And we're already with nominal rates in parts of Europe. I think this brings to bear the really appropriate question that you just put on the table, which is moving forward increasingly to drive aggregate demand, you're going to need to see strong political and fiscal leadership in coordination with thoughtful regulatory and monetary policy to drive economic growth. And I think it's wrong of all of us to assume central banks can solve structural problems. What you're seeing in the global economy, and you use the word stagnate, I don't love that word. I think it's slowing, not stalling. You're seeing secular changes and forces at work related to demographics, related to industry business models, related to technology and what that's doing. And all those forces are resulting in a slowing rate of growth, not a stagnating or stalling rate of growth. It's slowing. But to think that central banks, by just dropping rates or pushing liquidity into the system, can solve fundamental structural issues related to infrastructure, education, healthcare, that's not the art of the possible for central banks. So I think what you're going to see is emerging is increasing dialogue and a necessity, actually, for great political leadership working in conjunction with other regulators to ensure, how do we stimulate and for the longer term get positive aggregate demand?
I mean, I have more confidence in central banks than great political leadership, I would say.
That's your comment, not mine.
I guess it depends where you are in the world. I think of stagnation because I'm here, obviously in Berlin.
Right.
In the U.S., I think you expect a pickup in growth in the second half.
But let me just keep, I would challenge in terms of stagnation. We look at Europe. And yeah, in aggregate, people are saying, 1%, 1.5% growth. But we look at all these companies that need to globalize, Montclair, Golden Goose. These are growth companies that we help and drive sales on a much more accelerated basis than they otherwise could do on their own to very successful outcomes. Or we take incredibly large companies that are buried within conglomerates, and it's a win-win where we're carving out entities like AkzoNobel, Atotech. And these are companies that the shareholders of the sellers win because it frees up capital to redeploy into their core business. Yet there's a new focus that's put onto these companies that are really terrifically well-positioned companies, and with management and a fresh approach and with our longer-term perspective, you can really drive change and drive value. And so I actually look at Europe, and while in aggregate you may, it's your description, not mine, I actually see much more opportunity with respect to growth companies that can globalize and large world-class companies that are already quite global that could use a fresh step in approach to drive value.
Do you find better valuations here? I mean, it has become cliche to talk about the dry powder in the industry at this conference.
I think valuations are high everywhere. You cannot help but have a situation where when the central banks have reflated like they have, where asset prices it's across every asset class. The key to this dry powder question isn't to focus so much on the fact that, oh my God, there's all this dry powder, how are we going to put it to work? I've never seen deal flow as high as it's been recently. Because you have to focus on the fact that the opportunity set for private capital has expanded enormously. The number of public companies are down. There are twice as many private companies as there are public companies. Every single asset class is now opening up to private capital. It's not just private equity. It's private credit. It's private real estate. It's infrastructure. All strategies from buyout to growth, long dated, are opening up. And you have to think about this in the context of every single region in the world. Japan, the third largest economy in the world, is just now starting to open up to more M&A activity and private capital. And so when you take a step back, I think it's very much the trend, and I think it's secular. I think it's here to stay. It's going to keep going, where you're going to see great opportunity set emerging for private capital, and it's just going to continue. So yes, there's a lot of quote-unquote dry powder. You can't talk about the supply side of the equation without the demand side of the equation, which is the opportunity set is increasing. Entrepreneurs and companies increasingly want to partner with folks like us. And the real issue isn't, can we put it to work? I mean, I could put a lot of money to work tomorrow. Prices are high, there are lots of sellers, they want to transact. The issue is, what are the right situations to put our capital into? Because driving value and creating returns when we're paying such high prices is exceptionally difficult. The room for error is very small, and deals are being priced, I don't want to say quite to perfection, but let me just say almost to perfection.
But doesn't that mean you'll make less money in the end? I mean, at the exit?
You know, people have been saying private equity is going to be making less money every year since I've been around in the business. In aggregate, on average, one could assume this amount of capital and the competition, the math would suggest returns could drift. Having said that, it's really important to understand relative returns against public benchmarks. And my strong view is that that premium will continue to exist because you know, please keep in mind, we're doing something at these companies. We're making them better. We're driving change, and that is going to be reflected in the fact that we believe we can continue to outperform.
Are you going to be? Do you think that we're going to see in the industry more companies being taken private, as you have 5 or 6 companies that you want to take public in the pipeline?
well, you know, going privates are clearly a way to get investments done and deals done. I think take privates may be harder right now because of the fact that public markets are so expensive. Multiples are so high. So if I had to make a bet, my gut would be you're going to see much more investing into private companies for growth. I think you're going to see much more carve-outs on a negotiated basis for private, you know, entities, subsidiaries within big public companies. And every once in a while, you might see a take private. I personally think valuations are exceptionally high in the public markets, and to count on that being a huge source of deal flow, I think is maybe, you know, I'd be cautious.
What about the IPO picture? Because you do have companies you want to take public. Valuations are high, and there's a lot of volume right now, so it would look like a great situation, and yet the big name IPOs that we've seen lately have floundered.
Well, let's keep in mind the IPO markets are increasingly less the preferred avenue of approach for exit. I would say sale to strategics are probably the more preferred way to go. Having said that, the equity markets have opened up. Just this year, we've taken 2 companies public, actually more, and they've all done really nicely. And it's access to capital that wasn't quite available, I would say, last year, but the markets are much more robust now. We have to keep in mind, though, when you go public in a private equity or private capital context, it's just a path to liquidity. It's not an exit. It's the start of a journey to an exit, which could take 2 or 3 years. So we really have to, we're going public, but we have to keep our eye on the ball in terms of driving the company, continuing its growth, you know, doing great things with it. So it's really a multi-year journey that starts once you go public. But the good news is I think the equity markets for the right type of companies are open now, and it's an available path for liquidity for private equity.
I want to talk a little bit about things you want to buy.
Sure.
You've built a credit business at Carlyle. Did you ever think maybe I should go out and buy a turnkey solution rather than doing this organically? Or do you see anything like that in the pipeline?
No, at Carlyle, we like to do things the old-fashioned way and just build them on our own, and that's our natural instinct. And in a human capital business where culture is incredibly important, especially in investment ethos, our strong preference is to build rather than buy. which is what we've been trying to do in credit. It's doubled in size in just a handful of years, and it is a wonderful platform we've now created with all types of credit strategies. We will use our balance sheet strategically and opportunistically, as we do with Fortitude, as we do with our aviation finance platform. But that's not our natural instinct. Our natural instinct is to say, let's figure out what strategies make the most sense. Let's figure out who the best people are. Let's start to build and drive on that strategy. Let's talk to our best partners and bring them into that strategy. Let's perform and show them what we did, and then grow organically. And then every once in a while, if something makes sense to do, if there's a cultural fit, if it's truly an extension of our strategic capability as opposed to just a financial maneuver, yeah, we'll use our balance sheet to make an acquisition.
Anything you see out there right now?
I can't tell you that. Let's just say things are expensive.
What about other assets? I mean, what areas do you like right now? Where do you see value?
Well, I think it's less about value in general and much more about where can you drive growth and find growth. I do think in certain regions or in certain asset classes or in certain sectors, there's value to be had. You know, maybe in Japan, maybe in certain energy markets that are going through transition. But by and large, I think the game right now to drive returns is much more driven by growth. Those platforms that are set up globally with strong industry sectors that have an ability to find great management teams and partner well with them, they're going to be the winners.
I want to finally, we don't have any time left, but I want to talk to you about the transition that you've made that I sort of started out talking about.
Sure.
You're the first big private equity company that's passed the torch, so to speak, or David and Bill and Daniel passed it to you. Do you think that you have an advantage due to this? You have a new generation at a time when it's necessary?
Well, first of all, look, our founders are terrific, and they're still involved. We want them to be involved. They add tremendous value. Second, the torch wasn't passed just to me, but a generation of leaders. Me and my partner, Glenn, we're part of a broader team driving. I think what's happening, and I'm going to take this out of the Carlyle context, and let's talk about the industry. We are maturing. The industry is getting more sophisticated. Our businesses have to become more institutionalized. We have to think about stakeholders, not private insiders. It's very important that we think about the whole ecosystem of Carlyle. It's not only our limited partners, but it's our shareholders, it's our employees, it's the communities we live in, and driving long-term value across all of our stakeholders, immensely important. You can only do that as you continue to institutionalize the firm. You adopt modern-day governance. For instance, we just did a conversion. It's one share, one class of stock, one vote. Very transparent, very aligned, very simple. But these are practices that we do every day in our portfolio companies, where we're driving to make them better. We're bringing diversity to the boards, where we're improving the governance, where we're focused on the real drivers of value over the long term. That's all we're doing at Carlyle. It's nothing different. It is though.
You have a more holistic approach than a lot of others. I noticed in a 2018 Bloomberg Market story by Jason Kelly and Heather Perlberg, you were talking about the succession. That was the article of that at the time that you're doing at Carlyle. You also want to see this succession planning at the companies that you buy, and the same is true with. I know you hired 50% women in the last period, and you want to see an approach to diversity in the companies that you operate as well. Are you going to become more activist in the?
It's not about being activist or passive. It's about how do we make the best decisions on behalf of our limited partners, on behalf of our shareholders. This is a judgment business. We have to make great judgments every day on big sums of money. You can only do that if you have a diversity of experience and background and insights around the table, because the world's a complicated place, as you pointed out. So this is not about a statistic or saying, this is what modern day corporations have to do. This is all about the essence of how we can really perform better. So we need all of that to make the best decisions and the best judgments possible so that I can deliver returns for all of you and thereby expand and make our ecosystem healthier. This is all good. It's what we're focused on. We're investors. We're a global investment firm. It's all about partnership. But at the end of the day, it's all about people and culture, because that's truly what is needs to be sustained and institutionalized. And we're off to a wonderful start. Our founders had a great vision. They created a wonderful place. It's now our job to take that and make it even better. I'm confident we're on the right path.
All right, Q, thanks so much for your time. Really
Terrific.
appreciate it.
Thank you very much.
Kewsong Lee
Yeah.
there from Carlyle.